The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good Friday morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN just after 9 a.m. Eastern Time, and we got a wild one shaping up today. So you get Amazon out with their numbers after the bell last night. They trade lower. We come into the non-farm payroll numbers at 8:30 this morning with the markets already in lower territory. You see the S&Ps. Now, quite the run yesterday, quite the run overnight. You hit 5,600 on the dot to begin the session yesterday. Things look rosy when I was on the air yesterday, man. Not so much the case. It was quite an escalation to lower prices. You trade lower overnight, and boy, we get a little bit of a surprise to the downside. A little bit, might be putting it lightly with some of the rhetoric out there going on. You get the S&Ps nonetheless down 1.6%. That's 87 points in the red with a 53 handle, 53.93. We dive to 53.76. Let's put it on a 5-minute, even to get a little bit shorter term. We zoom in on that 8:30 jobs number. NASDAQ 100, as I mentioned, already trading lower on some of the Amazon numbers that they were trading lower. You're going to have Amazon down almost 10%. We'll jump to them right after the markets. NASDAQ 100 off 2.2%, off 428 points, 18,595. You got the Dow off 449, 1.1%. The Dow, the strongest index, as in only down barely 1% right now. And how about the Russell? The biggest scare of all, we might have a growth scare. And is the Fed late to the party, right? Are they going to have to come in ferociously to save this market that might have a growth problem? Well, the Russell's saying maybe so when you're down 4%. 4%. And that's not counting that we were just trading at 2280. Okay? I mean, folks, yesterday on the air, we were trading at 2280. We just hit a 2,000 handle of 2,097. You lost 183 points, all right? 8%. The Russell just lost 8% from where it was trading at yesterday morning. Pay attention to the market. Doesn't mean it's going to happen, but you better realize that there is the possibility here. The Russell just gave back everything that it had done. No rotation going on in this market right now. There might have been a rotation if we were going to get a little bit of a cut and the economy was going to fare well, okay? But if we get cuts because the economy is not growing, that is a different story for the Russell 2000, and the charts are illustrating that. So how about it, right? 4% down today, 4% down yesterday. Check out those red bars, man. Those are a couple nice daily bars. Not nice to the upside, but boy, they are dramatic red bars when you think about you just took back everything you did in that whole, I mean, we talked about it when this thing had a run. That was the best outperformance the Russell had versus the S&P 500, I think since like 86, 84, something bonkers in terms of how the Russell had performed over like a 7 or 15-day period of time when it had this run up in the beginning of July, and you wipe it all out just like that. We're trading at 2113 right now. The day is young, but we'll see where we go. Bitcoin jumping around, not quite the case. Bitcoin up $1,200. You're seeing a little bit of a divergence here, right? Crude, though. Crude trades lower, man. Growth scare. Watch out. You already came into that number trading lower, and you are trading lower. 74.79. Cheaper gas coming at you. Now, we have yields dropping dramatically. Okay, let's jump to the dollar before we do this even. DXY. Yields dropping dramatically. That's going to weaken the U.S. dollar. By weakening the U.S. dollar, that's going to help the gold contract. And gold hits $25.22 this morning. You pair some of those gains. You're still up by $27 on the session right now on gold. You take a look at the daily. I mean, are we going to break away from this higher range? It's not outlandish, folks. All right? Yeah, 2,500 seems wild. But when you think about the fact that gold was trading at 1,900 13 years ago, right? Remarkable. And that was a period of time, folks. Gold shopped around trying to push 2,000, okay, near the 1,700 level for more than a year. You traded from August of 2011, when you made that original run, up to the highs of 1917. You make 1923 in September of 2011. You trade to 1,800 about in October of 2012, and then you really pull back. So you had a year that you were up to 1,900. All right, we just chopped around at that level. You can see how it took us how many years? From July of 2020 until February of 2024. As my dad would probably say, potentially building some cause to break through that area. And yeah, we'll see, man. If the Fed is really going to come with it, and they just may have to, we'll see where we go. You check out the dollar index, okay, for some context here. If the Fed really needs to bring it, you better believe that, yeah, they're not afraid of going back to the lower boundary line. And look where the dollar has been. Anywhere since 2001, 2002, look where the dollar has been. There's a real risk here that the Fed is going to bring it, that they may be late to the party, and I don't expect them to admit that, okay? But you better believe that that's a real risk. The way I like to look at the market is you think of a number of scenarios that can play out, and then you give those range of scenarios a probability, okay? And there is a distinct probability that the Fed is late to the party when it comes to cutting when you see some of this data, okay? And if that is the case, they're not going to be able to go with a slow, melodic interest rate cut path. They're going to bring it quickly to spur economic growth because they have held rates way too high for way too long. And that is what the market is saying this morning, man. And let's get over to the numbers. 114,000 jobs added, weaker than expected. Unemployment rate rising to 4.3%. Hourly earnings come in soft. That could be your trifecta right there, right? Weaker jobs numbers, higher unemployment, and hourly earnings coming in soft. Hourly earnings coming in at 0.2%. They were looking for 0.3%. Jobs come in at 114,000. You had revisions in the prior couple of months of 20-something thousand to the downside. So if you add the revisions to the headline jobs number, you actually come in at under 100,000 on the net add there. Participation rate ticking up to 62.7%. We'll get into some of the other numbers that they talk about in here. Yeah, and there it is. Average hourly earnings, 0.2% month over month. The market was looking for 0.3, so even earnings come in soft, okay? Big miss to the downside. This is just some of the rhetoric that was coming out right at around 8:30. And yeah, it is quite a number. Now you jump over to the CME FedWatch tool. Again, I always say, not the Holy Grail, okay, not the Bible to any degree in terms of what they're going to do, but you better be paying attention to what the market is pricing in right now. And the market is pricing in a 2-to-1 probability that they cut 50 basis points come September right now. 50. And the only other chance is 1. There is a 0% probability priced in right now that they're not cutting by September, okay? And the only variable is that the market's saying you got a 2-to-1 chance that they're actually bringing it by 50 basis points by September. We're going to get a lot of data by the time they get into September, you think about it, okay? We're going to get the entire month of August data. And if that ever lines up extraordinarily weak, then watch out, man. Because if they have to start coming with 50, 25, 25, 50, and they're cutting to that degree, yes, that is going to matter. And, you know, things can change, okay? And what I love about this FedWatch tool most is not where we are right now, because that's important, but always illustrating where we were even a month ago, okay? A month ago, folks, there was a 31% chance they weren't even going to cut yet. There was a 63% chance that maybe they cut by 25. There was only a 5% chance that they cut by 50 basis points by September. Well, now that's a 63% chance. We got a lot to talk about today. Stay tuned, folks. We'll be right back. If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
In the world of trading, only a few names stand out like Larry Pesavento, a pro's pro with over 50 years of experience. Larry has seen it all. A former Chicago Mercantile Exchange member, Larry has authored 10 books and trained over 1,000 traders with his unmatched expertise. Introducing Fibonacci 24/7, Larry Pesavento's daily trading service that turns the complexity of markets into opportunities. Published every Sunday, receive a comprehensive report packed with detailed commentary, charts, and videos that illuminate the patterns shaping the markets, with updates throughout the week exclusively for subscribers. Whether through charts or videos, Larry's analysis is your roadmap to navigating the markets. You can sign up now at TFNN.com for just $97. And with all TFNN newsletters backed by a 30-day money-back guarantee, you have nothing to risk. For all the details, visit TFNN.com. You'll find Fibonacci 24/7 right under the newsletters tab.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN has launched the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
This portion of the Morning Market Kickoff is brought to you by Direxion's daily leveraged and inverse ETFs. Whether you're a bull or a bear, you choose the direction. Visit Direxion.com. Investing in the funds involves significant risk and should only be utilized by investors who understand the impact of leverage and actively monitor their portfolio. They are not designed to track the underlying index or security for more than a day. Before investing, carefully consider a fund's investment objective, risk, charges, and expenses contained in the prospectus available at Direxion.com. Read carefully. Distributor Foreside Fund Services, LLC.
Welcome back, folks. Get the market pairing itself a bit. S&P is only off by 68 points right now, and it is interesting that basically you're almost right back to where you were prior to that jobs number, right? The market was already dramatically in the red coming into this number. You're trading at 54.15 right now, and that's where you had the S&Ps trading. Early this morning, markets were already deep in the red coming into that number. You got the NASDAQ almost back at the same thing, right back where you were. And we'll get into these numbers a little bit later. We're going to finish up the macro conversation, but there is Amazon down from 184 to 167. You were trading at 191 pre-market yesterday. So yeah, you're talking about quite a haircut. For Amazon shares, what are they going to be down on the open? Yeah, $17, almost 10%. And okay numbers. You know, I'm not going to say great numbers. I got some Amazon, okay numbers for Amazon, but you see how this market, you could call it price for perfection, right? Not exactly perfection, but boy, decent numbers for Amazon, but the market is worried. If you're not delivering across the board right now, they're worried and you are getting penalized. And Amazon may be in, at least for the later part of this fiscal year, they are in a period of time where they're going to spend and profits are going to forego their main goals. And that is a company that is not afraid to do that, as we know for some time. And they're seeing an opportunity to spend money in capital expenditure for future growth. And on a shorter term basis, the market is penalizing them at this period of time. And yeah, you're at 167. Now, getting back to this market for a moment, okay? Taking a look at the yield curve real quickly, okay? Yeah, you talk about a move on the 2-year. Now, they talk about it here. Right after that jobs number, the 2-year yield tumbled 29 basis points to the lowest in a year. Now, that is driven by where the Fed is going, okay? That's not talking about where long-term growth is. That's not talking about the 10-year. The 2-year yield is driven by where the Fed is going, okay? And the 2-year right now is sitting at 3.97. It has popped a bit. You have the change now down about 19 basis points. The 1 year down 22 basis points. The short end of this curve tanking. The 6 month down 15 basis points. You got the 10-year yield now sitting under 3.7%. You're down 11 basis points on the 10-year, and the 7-year down about 13 basis points. So you see the move. Okay, we've pulled up the charts. All right, but you see the move. Pay attention. The market is saying, hey, the Fed is coming. They're going to bring it. And, you know, I put out in my newsletter earlier this week that they're coming in September. The chairman wasn't going to be overly enthusiastic with his wording. That was to be expected. He's been data dependent all along, and that's what he's going to stick to. But, boy, pay attention to the data, because the data is now lining up, and they are not going to give the Fed much room if this continues. I mean, you add the net revisions to the prior 2 months of jobs, 20+ thousand to the negative, and then you add that to only gaining 111,000 this month. The economy just added less than 100,000 jobs for the month of July. Unemployment has now risen to 4.3%. What was our low? Was our low 3.4 or 3.5? Think about the number of real jobs. I mean, we talked about this. Remember these numbers when we say, geez, you know, if the Fed needs to raise the unemployment rate 1.5%, that is going to be X amount of real life people that are going to be out of a job. I know it seems like a small number, and maybe it's something that's necessary because the economy can't handle an unemployment rate at 3% without overheating. But we're now at 4.3. What was the low? Can somebody help me out? Was it 3.4, 3.5, I think was the low for the unemployment rate? Something like that. So we are now approaching a full percentage point higher on an unemployment rate basis. We're adding less than 100,000 jobs on a net basis out there. And we'll see where we go from there. But you have the 10-year, and yeah, we've pulled back a bit. Okay, you got all the way up to 114.08 initially on that number. You're back to 113.19 right now. But, you know, that's why I like to take a look at that Fed Watch tool. At least gives you a general idea, okay? And I always say it's not the holy grail to follow that it's, you know, but you better pay attention to the shift in the market sentiment when you now have a 2-to-1 factor that they're going 50 basis points from September. Things can change in a month. I bring that up as well. A month ago, that number was only 5%. They were going 50 basis points. Now it's basically 65%. Okay, so wild stuff across the board on that one, to say the least, right? Pretty remarkable. All right, let's jump to some of the numbers we got last night. Let's kick it off with Amazon. So I got a couple articles out here. Interesting. One thing I wanted to talk about quickly, the type of capital expenditures, and we all know it, but how about it, man? Amazon spent $30.5 billion on capital expenditures in the first half of the year. You know, these numbers, and I was talking about this yesterday, I mean, data centers, okay? They're building out data centers. Who is going to be able to compete with these companies, man? There are going to be a select few companies. We all know them. It's going to be Amazon. It's going to be Apple. It's going to be Google, okay? It's going to be Meta. And they're going to run the world. And so I hope that at some point the governments are going to allow some type of benefit to the people, man. And that shouldn't be political, because I don't know how you're going to compete when you literally, I mean, this is futuristic Terminator style stuff. And I'm not, you know, we'll be okay, but we're going to have to be vigilant, because these companies are going to run everything. And the amount of money that they are plowing into server farms at a time when there is going to be a generational shift in AI that is going to control everything, okay? It's remarkable to think how anyone is going to be able to compete with these big tech companies on this forefront. I found myself today, I looked up, I was like, man, what is the GDP of some European nations that just the capital expenditure of these tech companies to build out these data centers is, I mean, look, one company spending $30 billion in half the year. So you multiply that times 2. Amazon alone spending $60 billion, okay? Microsoft, did I even say Microsoft before? Yeah, I must have, right? Azure, of course. You have Microsoft, you got Apple, Google, Meta. I didn't even say them. Those are the ones. Those are the 5. Hey, so let's say there's 5 companies. They're all spending $60 billion a year. I'm just, you know, simple stuff, right? We're at $300 billion a year just spent by those 5 companies to build up data centers, okay? And you go to, like, this is a list, just for context, of the GDP of European nations, okay? Now, you got These are trillion numbers at the top here. Germany's at 4.5 trillion. The UK's at 3.5. But you don't have to go far. A country like Switzerland, okay? Their GDP in 2024 is only $938 billion. Those companies alone are going to produce basically half of the GDP of the entire country of Switzerland in a year. That's the number in a year of just their capex of those 5 companies. It's just putting in context how much money. Sweden, $623 billion for GDP for the entire year 2024. The capex of those big companies alone spending to build out data centers are going to be about half the GDP of the entire nation of Sweden. Good old Ireland, my heritage, 564. It just puts in perspective how much money some of these companies are spending, man. We'll go over Amazon numbers in a bit. They're growing the cloud, man. But that is not enough, as they are not going to take it in and profit. We're going to talk about Amazon. We're going to talk about Apple. We're going to talk about Intel. We're going to talk about Snap. And we're going to go over the market. Stay tuned, folks. We'll be right back.
The consistency you're looking for is closer than you think. 1 or 2 adjustments are usually all you need to change your equity curve from red to green and keep it there. Come join Larry Pesavento live to learn what separates the winners from the losers. Join Larry Pesavento on the 2nd and 4th Friday of every month for 3 hours of live trading from 9 a.m. to 12 p.m. Eastern Time, where Larry will show you the market setting up and, most important of all, the state of mind of a winning trader. By watching Larry trade, you'll learn the Fibonacci levels, you'll learn how to apply A to B to C to D trading patterns, you'll learn trade management, pattern recognition, and much more. Join Larry Pesavento Friday, July 12th and Friday, July 26th, 9 a.m. to noon Eastern Time for 3 hours of live trading. For this month only, use promo code LarryJuly24 at checkout to save $50 on your first month's subscription. For all the information and to reserve your spot today, visit the front page of TFNN.com.
If you spend any time online researching trading techniques on how to begin your trading journey, you've no doubt come across many folks who push Forex trading as a way to make big money quickly. Unfortunately, there are equally as many stories of these so-called Forex professionals just looking to make a quick buck off aspiring traders without actually teaching the ins and outs of the Forex market. This is what sets Teddy Keckstack's The Tiger Forex Report off the riffraff. Every Monday, former Chicago Mercantile Exchange member and author Teddy Keckstack releases his Tiger Forex Report newsletter, where he dives into the complex world of Forex and takes time to actually teach you his methods that have made him so successful in a fast-paced and rewarding world of Forex trading. Furthermore, all subscribers receive access to archived live streams of Teddy's, where he provides university-level education to help you in Forex trading. All first-time subscribers receive a 30-day money-back guarantee. So what are you waiting for? Forex awaits.
The stock market is a delicate, interconnecting web of commodities, equities, and trader psychology. When one string of the web is pulled, it has a ripple effect across the broader market. This is where opportunity lies. But how are you to gather all of this information into one cohesive model when you're already spending your energy looking for any possible trade opportunities? Luckily, you don't have to worry about that, as Tom O'Brien has brought all important market news to you in one single newsletter, Market Insights. Market Insights provides a daily overview of what's happening in the indexes, bonds, gold, and more. Follow along with Tom daily as he analyzes the components that affect the overall movement of the stock market, giving insight into how each one plays either a bullish or bearish role. Tom also analyzes specific equities that he believes has the potential to make huge returns, and his track record proves his analysis right. All first-time subscribers receive a 30-day money-back guarantee. So what are you waiting for? Don't let the market leave you in the dust.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV.
Welcome back, folks. We got markets open. You have the S&Ps off by 82 points. NASDAQ 100 off by 403. They're talking about NVIDIA over there on the YouTube Tigers Den. And yeah, quite a move, man. NVIDIA off by $6, 5.4%, 103.35. Will it get to that magic number of 100 today? Pretty remarkable when you look at that. It was at 120 yesterday. The one thing I find myself, one of the many things I find myself thinking about this morning, folks, is NVIDIA at one time was the most expensive company in the world. They held that briefly, okay? Look at Apple. Oh, man, look at this. Is this a flight to quality? It may be. Look at this. Apple goes positive on the open. Remarkable. They selling NVIDIA and going into Apple. So what I was going to just do was say, look at Apple is at 3.3 trillion. NVIDIA is now at about 2.5. Yeah, 2.5. So Apple is now 34% above the value of NVIDIA in a pretty brief period of time in terms of how they were in that area, right? NVIDIA got that crown briefly at 140.76. We're now at 100. I don't think that it's common for the most expensive, largest company in the world, and this is just like one of those things that you really want to have the spikes up on your back, right? Is that now, you had a little bit of weakness out here, okay, in certain equities. Intel paying the price, man, down 25%. I was talking about them earlier in the week. They're laying off a couple thousand people, thousands more. That is a story that they're now telling, that somehow they're going to lay off people to save money, to plow it into research and development. Any company can do that. Any company could just say, we're just going to start spending money to catch up and make chips that can compete with AMD and NVIDIA. That's a story that's getting told. It's not based on fundamentals at all, and they're getting punished on their earnings, down by 26% right now. Now, back to NVIDIA, though, okay? NVIDIA has 25 billion shares outstanding, okay? So you're down $5 today. You're down $125 billion market cap, all right? But you're down $20 from where you were just trading yesterday morning, all right? You're down almost 20% from where you were yesterday. It's somewhat indicative that maybe they don't deserve to be at the top echelons if that's the type of divergence you can have instantly. Now, all you're doing is you're back to where you were July 30th, okay? This type of volatility, not indicative of strength usually, okay? You just traded from 140 down to 100 basically. You were at 102.54 on the 30th. You made it back to 120. They call that a dead cat bounce in some circles, and you're back to 103.13. Be careful when equities lose 20% of their value without a shocker. That's the real point, right? Without a shocker. Yeah, if you come into earnings and you shock the world that you're not doing what they thought, then that's one thing. That didn't happen in the last couple of days to NVIDIA, okay? Did not happen in the last couple of days to NVIDIA. And when do they come out with their numbers? Probably sometime later this month. They'll come out with their numbers, but you are almost back to this entire area in terms of we got a nice gap in there from their earnings a quarter ago. And be pretty remarkable if Amazon goes up 50% and gives it all back in the span of one quarter, which is what they're basically looking to do. They came into that last quarter at about 93. You drive up to 140. That's a rise of $47, almost 50% on the dot, and you're now back to $100 at 103.41 for NVIDIA. We jump over to Amazon shares. Yep, they're down by $17.7. They're off by almost 10%, 9.7 on the downside. So let's take a look at Amazon numbers. Now, I talked about the CapEx, okay, which is remarkable, putting it lightly. Let me find that. Where are we? There we are. All right, here we go. Amazon slides as spending playbook risks disappointing investors, okay? Executives say the cost will rise to meet the demand for their AI services. AWS jumped 19%. Now, that is quite a number. Operating income for the current quarter, though, this is where they're getting penalized. 11.5 to 15 billion. The market was looking for 15.7. Listen, on a longer term basis, and I got Amazon, longer term, I'm an Amazon bull, okay? But you're only talking about a few billion to the bottom line for a company. That is not a longer term problem, okay? But that is what the market is looking at right now. They are. And they're getting penalized dearly for a market that is priced for perfection. Yeah. They focused on cost cutting in the last 2 years, but guess what? That's not the case anymore. They're going to try and capitalize off the boom in generative AI, which can create text, video, images, as we all know. Amazon has said the opportunity represents a multi-billion-dollar revenue run rate business, is what they're talking about here. And they're getting penalized because of those profits. Now, Amazon Web Services, 19% sales growth in the second quarter. That's a bigger number than what the market was looking for. Now, it's so interesting, right, in terms of where we are in this cycle. That used to be all the market cared about. What's AWS doing? Is it growing more than we thought, or is it not? It's growing more than the market projected, but that's not where we're at right now. They're worried about profits, okay? And that's where we get to the capital expenditure number I talked about, $30.5 billion in the first half of the year. Data centers required to power AWS, and they're going to spend even more than that in the second half. So there's the worry, okay? They're plowing money into CapEx. They're not bringing money to the bottom line because of it, and they're going to ramp it up in the second half of the year. We're seeing strong demand in generative AI and non-generative AI workloads. Yeah, and they're going to bring it. Conservative revenue guidance for the third quarter. Sales are going to grow between 8 and 11% to $158 billion in the quarter. Now, the market was looking for 158.4, but that's the top end of their range. If they grow 11%, that's going to bring them to 158.5. Meanwhile, the market was looking for 158.4, so they might have a little bit of a revenue problem. And when they talk about Amazon, consumers, okay, they have cautious consumers looking for deals. Big news events, and this is interesting, man. The Olympics is messing with their business. Yeah, people are not spending enough time just shopping when they're watching the Olympics, I guess. Big news events, including the Olympics, appear to have interrupted normal purchasing patterns in the current quarter, making it more difficult to forecast sales. Pretty remarkable when you're on that grand of a scale. Then when the Olympics come, everybody just stops buying the stuff they don't need on Amazon, and their business pays the punch. Now, the cloud business, record low sales growth last year, continuing to stage a comeback. And that's where, longer term, they're going to be fine. Okay. The market's worried slightly about a little bit of a revenue miss. They're worried about the profits for sure, because you're going to plow money into CapEx. You have a business, AWS, that's growing 19% to $26.3 billion. You're beating estimates, and it's the second consecutive period of quarter-over-quarter growth. They are growing more than the market was anticipating, man, and more than they were just a quarter ago. Pretty remarkable. All right, we got a caller. We got our man. Let's do it. Jose from Lakeland. Jose, good morning.
Top of the morning. Good to see you in the big boy chair.
I appreciate it, man. I heard you chatting with my dad a few days ago or last week. Always a good conversation. Good to talk to you, man. How's the morning going?
Yeah. Yes. The egg rolls are flying at Ling's Buffet in Lakeland, South Florida Ave. Ling's Buffet.
We love the free mentions for good food. Get it done. Why not? I'll have to check it out. Awesome, man. So, I tell you what, we're going to come into the break. What are we going to get into, Jose? Let's leave him hanging. What do you want to talk about as we come into this break?
I got a question about the Fed statement. I'm pulling my hair out of my head, and I'm almost bald.
All right. We all want to talk about the Fed right now. Let's do it. Stay tuned, folks. We're coming back with our man, Jose. We'll be right back.
Are you ready to take charge of your financial future? TFNN is your gateway to the world of trading and investing. Whether you're starting out or scaling up, TFNN empowers traders and investors of all skill levels with top-notch investing systems, strategies, and techniques. It's time to protect and grow your money with insight you can trust. Join us live Monday through Friday during market hours for exclusive content that moves with the markets. At TFNN, we bring the trading floor to you. Our seasoned hosts are here to answer your calls and questions live on the air. Check out the Tiger's Den for just $1 and follow us on YouTube and become part of our vibrant community. And remember, at TFNN, we're so confident in the value we provide that we offer a 30-day money-back guarantee on all new premium newsletter subscriptions and services. You have absolutely nothing to risk, so why wait? Tune in live to Tiger TV and transform your trading journey, because when you know better, you invest better. Join us and experience the difference today. TFNN, educating investors.
Many trading newsletters attempt to focus on a narrow set of equities or commodities. While this works for some, it oftentimes misses many opportunities that possess huge gain potential. But how is an independent trader supposed to scan the entire market looking for these hidden opportunities? One simple answer: the opening call newsletter. Basil Chapman, developer of the Chapman Wave trading methodology, has been trading the markets for longer than most trading influencers have been alive. And over that time, he has honed his methodology in order to accurately call movements in a wide range of equities, from semiconductors to uranium to key indices and so much more. Basil is old school, taking the time to educate the trader while also giving his insights into key indices, selective stocks, and more. Opening call subscribers also receive access to dozens of educational live streams that can be accessed at any time for your edification. All first-time subscribers receive a 30-day money-back guarantee. So ignore the pop trading influencers and start learning time-tested technical analysis.
For traders who crave risk, Direxion's daily leveraged and inverse ETFs provide opportunities to magnify short-term perspectives with up to 3 times a daily leverage, utilize bull and bear funds from both sides of the trade, and trade through rapidly changing markets. These are highly leveraged ETFs with daily resetting designed for short-term trading, not long-term investing. Whether you're a bull or a bear, you choose the Direction. For up-to-date pricing and performance, go to Direction.com. Investing in the funds involves significant risk and should only be utilized by investors who understand the impact of leverage and actively monitor their portfolio. They are not designed to track the underlying index or security for more than a day. Before investing, carefully consider a fund's investment objective, risk, charges, and expenses contained in the prospectus available at Direction.com. Read carefully. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. We got the S&Ps off 67, NASDAQ 100 off 307. These markets, though, pretty close to where we were at about 8:30 right now. We were already in the red. And we're talking to our man Jose from Lakeland. We're going to talk a little bit of Fed, important on a day like today. So, what in that statement, Jose? What are we talking about?
Well, I mean, first of all, I'm a little surprised at the rise in unemployment. That's kind of a shocker. But it's these superficial statements by the Fed. They're becoming laughable. It's no longer about raising rates, lowering rates. It's all about the perception. Powell says if things remain the same, then cuts are on the table. Of course they're not going to remain the same. They're going by this data-dependent stance. They're not going to be the same tomorrow. So I don't know why Wall Street's getting all psyched up about a September cut, which, by the way, is going to drive home prices higher, which is counter to what they're trying to achieve.
Yeah, the home price deal, and that's, I think you were talking to my dad about that one, right, as well, and he was...
Yeah, I'm a little shocked at no 10%. Yeah, well, you know...
I agree with him, man. If that happens...
He's right.
If they come with it, man, that is, there's a lot of people that are trapped right now that either, it is going to be a headwind that they're going to have to face, but I think they're a little late to the party, man. And I think that, Chairman Powell is a little scared, for lack of a better term, to use the stronger language that he might have to. I would love to get in his head this morning. We're going to get Jackson Hole later this month, and he might bring it there, man, because we're not going to get... a ton more data. It seems like, we're now at a point, Jose, I mean, you add up the 111,000, we had revisions of 20,000 plus, we're adding less than 100,000 jobs a month, and we got unemployment up to 4.3, and I was saying earlier in the program, I forget whether it was 3.4 or 3.5 was the low number that we hit this cycle.
Okay, but I have no problem with that because that's what they were trying to achieve anyway. They want people to lose their jobs. They want the guy that makes $100,000 to make $20,000 so he can only buy essentials. They're achieving that. But this is not the Fed of years ago. Greenspan or Paul Volcker or even Bernanke, this credible threat theory that's always looming. I mean, it doesn't make sense. They're data dependent, and he's committing to a September, but I don't even see it as a fait accompli, this September cut. I just don't see it. I think it's more jawboning by Powell, and you may not even get a September cut. And by the way, if he's wrong and he has to reverse direction after September, if he does a September quarter point, boy, he's going to be looking bad. He's going to be looking real bad.
I just don't see it in terms of where, I mean, we're so high right now with 5.25 to 5.5, and I think that may be the problem. If it plays out that they're late to the party, it's going to be because they kept them so high. I mean, maybe they should have sat at 4.75 to 5? What if they sat there? You could probably make the case that you'd still be restrictive. I mean, think about it, right? That would be, so we're at 5.25 to 5.5 right now is their range. If we were at 4.75 to 5, that would be a 50 basis point cut that needs to come in to put them in that range. So what would that put mortgage rates at? That would still put them at like 6.5, right? That would still put the cost of capital approaching 5%. You could still make the case that would be restrictive. Maybe they sat in a little bit of a higher range. And so I think that's why I've said all along that the interesting part was going to get to, not if they caught once or twice, because I think they were still going to be able to, in their own heads, be confident that they weren't going to let inflation rage if their overnight lending rate was near 5%, right? But they sat at almost 5.5% for an extended period of time. So it was very reasonable, I think, in my opinion, right, that they were going to come back down to near 5. Maybe they were going to sit at 4.75, because I think that would have given them some comfort to say we're not going to let inflation rage because the overnight lending rate is still near 5% right now. We're still pretty sure that we're not, we're in an area. But then what was going to happen, right? Then were they going to sit there? Where were we going to go after 2 or 3 cuts? Because, if you get down to 4, then yes, there's a very real deal that what if CPI gets to 3.5? What if we're at near 4, right? What if when they cut that, like you said, that's going to help housing, man. That's going to bring up housing prices. That's going to free up liquidity for people that need to refinance that might not refinance right now. So there is that impetus. But I think if they were near 5, you could make a real case that they weren't going to be as worried because they still could believe that they were going to be restrictive. And I think the data is lining up that they're going to have to get out of this 5.5% number.
I don't believe that. This 2% target by the Fed is kind of silly. It's around 2%.
I would agree
it's
there.
Around 2%. Look,
I would
I'm
agree there for
excited.
sure.
I got my first real phone call on new construction up in Spring Hill. I got to unload this dump. I mean, house.
That housing element, man, and I love the conversation you were having with my dad talking about the housing, talking about rates, because it is going to be interesting. We've been stuck at mortgage rates that are a shocker for many of us, man, because we were near, 4%. We were near 4.5. We were near the 3s for so long that it froze this market at 7. And now what's going to happen if we get what we get? The 10-year this morning, Jose, is at 3.7%, man. We were just at 5% almost. That's a 1.25 that just got shaved off the 10-year, which is a mammoth move. So if you get now, and usually the mortgage rates are tied to the 10-year, right? Usually you can make the case that mortgage rates are, predicated on the 10-year in terms of where they go. And the 10-year was just approaching 5, and now this morning, as of right now, I think we're sitting at 3.85. 3.85 is where the 10-year is right now. Historically, and this isn't the case right now, but historically, mortgage rates somewhere around 2% above the 10-year, that puts the mortgage rate at 6%, and that's being kind at 2.15% above the 10-year. So what happens? I think that at least those numbers are going to come down a bit, man. When you look at unemployment, those are real numbers up to 4.3%. Those are real people. And if we're only adding a net number of under 100,000 jobs on a monthly basis, and the trend is not the friend right now in terms of those numbers. You look at any chart, right?
Oh boy.
Those numbers are coming down, and if we ever get into the negative, watch out. Because if we're at an
Trump's going to have a field day with these numbers.
Yeah.
If Trump comes back, he's going to demand rates come down at half a full point at a time.
We live in interesting times, man, to say the least, right? No matter where you look right now.
Absolutely.
All right, Jose, I appreciate the call. Always good to talk to you, man.
Okay, thank you.
Have a good morning.
Thank you.
Yeah, it's a wild one. He makes some good points, in terms of how we come out of it. But, boy, that rate, 5.5%, it is a restrictive rate, man. And I think you're seeing the writing on the wall that, and like I mentioned on that 10-year, pay attention to the 10-year, man, okay? Because look at this move. Look at this move, okay? You're talking about from 107 to 114 in the span of about 3 months. That is a mammoth move in the 10-year, folks. And, it's going to matter. And I'd say that mortgage rates are going to start coming down a little bit. And that will help the economy as well. And boy, you talk about a save. You ever get this Fed that really rips rates lower? I wonder how that's going to contribute to that housing market. Just think about the amount of people, we'll finish this up, that have equity in their houses that they can't touch right now. And maybe they can if they get that opportunity to refinance. We'll be right back.
The Gold Report. As a precious metal, gold is still king. It continues to hold the most effective safe haven and hedging properties across the global major trading hubs of the London OTC market, the U.S. futures market, and the Shanghai Gold Exchange. The Gold Report. Tom O'Brien publishes his weekly gold report every Monday morning for subscribers, consisting of coverage of the XAU, HUI, GDX, the dollar, bonds, the South African rand, as well as 25 different mining equities with specific buy-sell recommendations. The Gold Report. New subscribers get a 30-day money-back guarantee, so you have nothing to risk. Subscribe to Tom O'Brien's Gold Report newsletter now at TFNN.com.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
The reality is that navigating financial markets can be risky. Markets can be chaotic and difficult to understand. Having the latest market advice can help you turn this chaos into a key for creating winning trades. At TFNN, we understand that it can be hard to find reliable market news. That's why each of our market experts offers their very own market newsletter, a must-have tool for every trader out there striving to find an edge in today's markets. TFNN newsletters cover every aspect of the markets so you can analyze the market before you trade. Try any of our great newsletters risk-free with our 30-day money-back guarantee. Just visit the Newsletters tab on the front page of TFNN.com. TFNN, educating investors.
Don't forget, you can listen to TFNN live on your mobile device 24 hours per day. Go to TFNN.com, then hit Watch Tiger TV. That's TFNN.com, then hit Watch Tiger TV.
Welcome back, folks. You got Apple shares. One of the lone highlights on today. Look at that charge higher, man. Apple is up $10 from where you opened, from $214 to $224. We're pushing the highs of yesterday. Apple up by 2.6%. Apple out with their numbers last night. Revenue growing 5% in the quarter, faster pace than expected. It is pretty remarkable when you look at the stagnation of their revenue, and we finally get a little bit of a pop. You had declining revenue numbers. And what is that? Going back to Q2 of 2022 when, man, they just crushed it. Right? But you're talking about you had 4 negative quarters, 1 positive by 2%, 5 negative quarters. So you had 5 out of 6 negative year-over-year quarters for revenue change, and then you come in at a 5% pop. So market saying maybe they've turned things around. China, they struggled with a little bit, but they're coming into a super cycle. They are. Some of that already priced into this equity, though, if you remember the run-up it had. But this just might be a little bit of a flight to quality here. Yeah, and Amazon, you were trading lower. Double digits, down by $21. Quite the price for Amazon, man. You give it back. You're all the way back to where you were a quarter ago. right, to 160, where you were 3 months ago. Just like that, they closed that gap for Amazon, down by 11%. Meta was in the positive. You give it back, but they're slightly red, down by 1%, down by $5 right now for Meta shares. Nvidia, not quite $100, but you're near it, 104.41 for Nvidia. And we check in on yields with the 10-year. That is quite a chart, man. The 10-year. We hit 114.08. We're at 113.21 right now. As I mentioned, we're talking about a 10-year yield right at 3.85% on the dot, 3.85%. And yeah, the one case you can make is that at least the Fed has some room to cut, because that was the problem when we were in a low interest rate environment for so long, that the Fed had no room to spur the economy if they need it. The Fed has some room, man, and it's going to matter. I mean, you watch what happens if they really bring the cutting regime. Because just think about the amount of equity people have in their houses alone. The housing market, man, it will be. That's going to be one impetus for inflation, potentially, in terms of the flare-up there. But there are tons of people that have equity in their houses that cannot refinance right now, and that's going to be one area that definitely frees up if you get some real cuts from this Fed. But the market is saying 25 in September and maybe 50. Quite a change from where we were a month ago. Folks, stay tuned. Basil Chapman's coming up next. Have a great Friday. Have a great weekend. Thanks for kicking off your day right here with me, and I'll see you next week. Have a great one.